Okay, so far what we did with our um, learning program so far was to understand various factors that impact the stock returns. And now we're getting to a point where, hi Manish, okay, now we're getting to a point where we are looking at how can we predict what is going to happen, right? So all the while, what we did was, this is the sort of recap so far. We first did understanding beta, then we chose some benchmarks. We identified how to choose the right kind of peers. We then went into some fundamentals, revenue to cash flow, debt, competitive advantage, and then we switched back a little bit and then did the macro environment and the various macro cycles, etc. Right now, all of this that we have covered so far will help us kind of understand, correlate to the past, what is going on, etc. And to a certain extent, I can say explain returns as well as um, kind of get an understanding whether we are going in the right direction with the stocks that we are choosing. Now, in today's session, what we're going to do is we're going to, obviously, we're going to use the same set of tools as such, TradingView, Notebook LM. We will be using Gemini, Deep Research, the various data that we kind of rely on in our quarterly financial statements, annual financial statements. You've got the earnings call transcripts, etc. The various central bank papers that we used as part of deep research into macro cycles, etc. Right now, in today's session, we will get into predictive mode. So all the while we did explanations, got an understanding of how things work, etc. Are we selecting the right stocks? Now, with the same tools, we are going to jump into prediction, meaning with the stocks that we have selected and watch listed so far, are we expecting better than market sort of returns? Are we expecting just market returns, or are we expecting below market returns? That's the first question to answer. Is there a real edge over here? And then the second question to ask is, if I'm paying a certain price, is that price justified? Right. So that in effect is basically the essence of what we're going to be learning today as part of our session. Right. So the octofactor model as a pretty much like a sort of ready reckoner for us. We kind of know market beta. We first of all looked at the beta factors, etc. What which particular benchmark to use in order to identify this. We discussed a little bit about momentum. We looked at size, the various factors influencing stock returns. If you remember in the first session, we looked at this. Now we're going into valuation. And then we will then look at investment profitability, etc. We will talk a little bit about eco-efficiency today, but there's another session on basically the triangular conflict that comes up, in the later part. And we touched upon integrity and health to a small extent as part of a session on debt. When we looked at debt, we said, okay, it is part of fundamentals, but it is also a part of the integrity and health factor as well, right? So we used, the Altman Z-score in order to assess the integrity of the balance sheet. So that was one side that we did. So Now, what we're going to do is we're going to touch upon valuation and we're going to touch upon eco-efficiency, because these two are very, very interrelated. Right? One feeds into the other, and the other one kind of relates uh, to why certain narratives are being said in the market. Right? So, is it possible for us to be a little bit smarter about our, our kind of decision making? But if you actually look at it, a lot of what we do as alpha generation, so if you're picking stocks and if you want to basically generate alpha, the people who are passive investors, they actually hand it to you on a platter, right? Now, by understanding this, what you can really do is you can weaponize it, right? And this is how most active managers essentially kind of look at the market, and they are able to generate alpha consistently, right? If you just go back and look at what Warren Buffett says, his whole investment philosophy is based on identifying undervalued stocks. So his whole idea is, can I go and apply a certain valuation metric and decide, okay, this particular stock, is it undervalued in comparison to the sort of balance sheet strength that it has, the competitive advantage that it has, etc. Based on that, can I go and do this? Now, he also says, a lot of times, as a normal person, passive investing is right for you. Just buy the index and you'll be okay. And the reason why these two things are being said is one feeds the other, right? And we first of all needs to understand this very, very clearly. It's not just Warren Buffett alone. Every active manager wants a vast majority of the market to continue passive investing, so that this creates a infinite loop of alpha generation for them. If most people in the market decided to go active investing, drop passive investing, then it makes it tougher and tougher to hunt for alpha. Right? Now, here is how this works. Many of us here in the UK, we use tax wrappers. The HMRC knows every penny that you basically put into these wrappers. You can't really take it out that easily, right? It guarantees the investment phase, but does not guarantee the withdrawal phase, right? All the brakes will start hitting in when you start, thinking about withdrawals, right? So this means that there is a consistent investment coming in every month, every year, whatever is that, from millions of people. Every regulator in the world, every tax authority in the world has created some sort of a mechanism quite similar to this. The UK is no exception to it. Now, when you basically look at how people allocate money within the wrapper, yes, they give you an option. There is a certain type in which you can go allocate a specific set of stocks, etc. But then if you actually look at it, for most people, it is very simple to just choose an asset allocation based structure, right? So I'll say, based on my age, right, I will just choose this one, and I was, let's say 70% into equity, 30% into debt, whatever it's that. And then when you look at where the actual returns are being made, it goes into passive investing, meaning you're not doing any work at all. Basically, the fund manager isn't doing any work at all. They are just following an index. And how is that index structured? It's basically a market cap weighted index, right? So how does market cap weighting work? The bigger the market cap of the company, the higher the weightage in the index. So if you look at the S&P 500, the largest companies, largest market cap companies have about 35% of the index allocated to that. And then you have, if you basically take out those 7 to 10 stocks that are, stuck there, the remaining ones will be in a declining order of market cap, right? So this is typical, market cap weighted index based passive investing that a vast majority of the market is going to use. So what does this create for us? So what we are doing is this mechanism works in completely opposite direction to the way alpha is generated. So when you have a vast majority of the market chasing a mechanism that is opposite to alpha generation, it opens up an avenue for you without you doing a lot of work on your own, right? What are the major drivers of alpha? It is size and valuation, right? When you choose to invest in larger and larger companies, meaning most of your funds go into larger and larger companies. We all know the smaller companies tend to grow much faster. They generate better returns for us. But what we are doing is we are diverting our money into the larger companies. And then the other thing is also that because there is a consistent flow of money coming into this particular larger set of companies, the larger and larger companies will be significantly overvalued than basically the rest of the market. So this means that if you kind of remove, let's say, those most overvalued companies, a vast majority of the market can actually generate alpha for you, right? So one of the other things that we also have to understand is that we are told that stock returns over a long period of time works really well, etc. And then if you consistently invest over 10, 20, 30 years, etc., then basically you would have made significantly better returns. And as age progresses, you kind of asset allocation kind of changes. You go lesser on equity, more on bond or money market. But then we'll have to understand that all of this works well in the investment phase, right? So if you're in the younger age group and you're going to invest, you're never going to basically look at withdrawing money out of this one. Then essentially this method works for most people, and that is fine. At the point when people start thinking of withdrawing, this is where we can kind of weaponize it. There is a sequence of returns risk. I'll talk about this in the next few slides, right? And this basically gives us an excellent weaponization potential here. And because of passive investing, there are more and more undervalued stocks that are easily available to spot, right? So all that we need to do is kind of set a threshold. I call it margin of safety. Warren Buffett calls it margin of safety, based on Ben Graham's work as well, calls it margin of safety. You kind of use that and kind of draw a line in the sand and say, okay, I take things that are within this particular threshold. How much is that threshold? We will figure that out based on our analysis of the peers and essentially how this works for that particular sector, etc. Right? Now here's a graph that shows you the returns and drawdowns for the major indices. So you've got the FTSE and the S&P 500. Now, if you are in a perpetual investment phase, these points when the index dropped and then catch up, it drop, catch up, drop, catch up, that's okay. What if you need to withdraw? And this is where drawdowns work. The bottom part of the chart is what is called as the drawdown, right? Drawdown is kind of peak to valley kind of kind of a metric. So the topmost value to the bottommost value in that particular period itself. Right now, I've taken a weekly chart and I've plotted this for 5 years. So both indices, you can you can kind of test it out on TradingView. In our previous sessions, we've also done things like basically the what do you call the playback mechanism. So you can go and test it out on TradingView and see how the index actually worked, right, in the past 5 years. So what happens when, let's say, in the year when there was a drawdown, many people retire, or maybe they are moving their money from equity into bonds, right? They are moving at a lower valuation now, which means that as more and more people essentially do that, you are getting fairly priced stocks that are available to you as a value investor, as a stock picker, right, or as an active manager. You will be able to choose those and basically pick it, right? In a year when valuations are going up, like right here, basically, let's say the valuations are going up, the drawdowns are kind of low, you still find, except for maybe the top 10 stocks, a vast majority of the market is still undervalued, right? So this kind of presents us with, I can say, pretty much of a double alpha generation capability. So essence of this, basically the message is that as long as a vast majority of the market drives towards the passive investing route, it is still possible to easily spot undervalued assets and buy them at even lower prices, because when drawdowns occur like this, the valuations are actually dropping further down, right? And at that time, as an example, I can say some of the stocks in our portfolio, when we actually entered, we entered at maybe 60% discount, 70% discount, for instance, right? Is it possible consistently? Yeah, consistently possible. As long as you know that the fundamentals are right and you can kind of pick the right right metrics to choose, these mechanisms actually offer an excellent weaponized basis for you to get undervalued stocks consistently over time without doing a lot of effort, right? So you can go back into TradingView and kind of look at how the sort of valuations work. One example that I tend to give is that you can ask, let's say, go into Gemini Deep Research, ask it to get the constituents of the S&P 500 or the FTSE 100, whichever index you want to take, constituents of that, and order it by the price to earnings ratio. And ask Gemini to give it to you in a table format that you can export to Google Sheets, right? So it'll give you an option to export it to Google Sheets. You'll get basically a spreadsheet that gives you all the stocks in the index and the basically price to earnings ratio of those entire list of stocks. So just sort it, and then you'll figure out, okay, the index consists of this, and then what you can also do is when you're using Gemini, you can ask it to also give you the index weightage in the same table, right? So 3 columns. One column is the stock name, the second column is the index weightage, the third column is the price to earnings ratio. Take that, sort it by the heavily weighted ones, and then you basically look at it, you'll understand that a vast majority of the market is, vast majority of the stocks in the index are actually fairly valued versus a top set, maybe 10, 20, depends on essentially whichever index that you're looking at. That is where the market cap is higher, the valuation is higher, and that is where the index is allocating more and more money, right? But we all know from our previous sessions, we know that earnings are basically a matter of opinion, right? Our research, Helix did a lot of research over the last 10-year period between 2015 to 2025. Our back test and research kind of tells us that nearly about 90% of listed companies manipulate their earnings, right? When I say manipulate, some of us accountants among us will say, no, that's illegal to do. It is not out. So these are perfectly allowed within the respective GAAP or IFRS, whatever standard that they're using, perfectly allowed within that, and perfectly legal manipulation of earnings, right? If you basically look at it, over 90% of companies have manipulated their earnings. So one simple solution I have used is use the average earnings over 5 years. So when they manipulate earnings, it is not possible to manipulate earnings over a long period of time. So if you take 5 years, 10 years, whatever is the appropriate sort of a time frame, if you take the average earnings over 5 years, instead of one EPS value, you take that, divide the price by this average earnings of over the 5 years period. There you go. That's a fair valuation that you can get, right? Simple mechanism. And again, as I said, use the NVIDIA rule and the TCS rule, identify the peers that we have got, compare the valuations of the peers, right? Now, if you're comparing, let's say, Procter & Gamble, which was actually one of the examples that we took. If you're comparing Procter & Gamble with, say, Clorox or Kimberly-Clark, etc., then if you basically compare it to the peers, you will see over the last 5-year earnings, basically kind of look at it, then you'll kind of get an understanding whether you're paying too much of a price for this one, or are you in a sort of fair comparison sort of a bracket itself, right? So that's one easy mechanism. And as I said, if you go into basically into Google Gemini deep research, you can go and understand how the index worked and what sort of passive investing, capital allocation is taking place, and how we can kind of make best use of this. So some of the common things that the sort of financial media analysts kind of use as alternative mechanisms is one of the most highly reported metric is called EBITDA. It is the most reported, but the most, well, I can say, the highly speculative number. There is no scientific means to compare EBITDA between one company and the other. Right? That's reality. Even if you choose the best peers, you can't go and do an EBITDA comparison among peers, because the way things like interest, taxes, etc., is being used as business model enablers, you will kind of, I can say, it is like saying I will compare apples, oranges, grapes, and strawberries, but then I will treat all of them as fruit, right? One has a completely, let's say, sweet kind of a flavor, and another one has a tangy sort of a flavor. I don't care about that. Everything is a fruit. That is how EBITDA works. So highly speculative sort of a number. It just treats everything as fruit, and it just doesn't basically distinguish business model related changes, etc. And I would typically say don't even try using EBITDA for any listed stock. Couple of things that many analysts use are sales and free cash flow. Sales, highly contested number because sales is often restated, and quarter on quarter there are variations. Our research kind of tells us between 2015 and 2025, nearly half the listed stock universe inflated their sales numbers by at least 10%. Right, 10% is material change in sales. Right, so nearly half of the listed stock universe is kind of doing some sort of inflation. One excellent method that we saw over the 2015 to 2025 period is cloud contracts. Right, so cloud contracts enterprises sign are typically, let's say, 5-year contracts, or maybe even 10-year contracts for that matter. But then the sales is booked in one single quarter. Right, it shows that the sales was booked for let's say $560 million, $560 million. But then the operational expense in actually delivering the sales occurs over a 5-year period. Right, so it kind of inflates that particular quarter's earnings. But then if you basically peel it back and then look at what is actually happening, you find that majority of these contracts are longer term contracts, and you will accrue that revenue over time. Right, you will not accrue that revenue all in one go at that particular point in time itself. The other thing that also happens is, in a lot of times, B2B sales, quarter end kind of drives contract completion, etc. So sales is booked earlier on, but the actual sale itself comes later. So there is basically a timing difference as well. So if you kind of say, let's say the timing difference is not material, but then the inflation by at least 10%, which is basically material inflation, happens across the entire sort of listed stock universe, not just US stocks, not just UK stocks, across the board. Free cash flow is very, very clean to value, right, and is definitely recommended. So we saw in our session 4, is that, yeah, session 4, we basically looked at free cash flow and how to use it to value stocks. But this is only if the company has a very high integrity score. Right, integrity scores means basically, we'll kind of talk about it in the later sessions, but integrity scores means 3 things. One is the stock, basically the company that the stock represents, it's not going to go bankrupt in the near future. It's got sound fundamentals, and it's got a management that kind of walks the talk. Right, when I say walk the talk, what this means is that the management says, I'm going to deliver, let's say, 15% or 20% increase in revenue over the next quarter. In the next quarter, if you basically go and look at it, they are delivering on that particular revenue. Right, their revenue, if they're talking about cost cutting, etc., we're going to do this, we're going to do this over the next 1 year. If you basically look back at what they said versus what they actually delivered, they are actually delivering on it. Only then, if you kind of rate the integrity on the higher end, and more importantly, there are no shenanigans with respect to their accounting, and we also find that you can manipulate one financial statement, but it's very difficult to manipulate all three financial statements, right? So a company has three financial statements, right? One is the balance sheet, the second one is the profit and loss statement, and then the third is the cash flow statement. It is very difficult to manipulate all three of them at the same time, and that to do it quarter on quarter consistently. You've got to be Enron to do that, right? That takes excellent skill sets and whatever. So that doesn't happen a lot. So if you have confidence on all of this, and then you're giving them a very high integrity score, then using free cash flow to value that company is a very fair mechanism to do, right? Even then, comparing price to free cash flow is a crude method only, because free cash flow is P by FCF ratio is available on TradingView. You can go and use that. It is a crude method only, and the reason why I say that is free cash flow isn't generated without loading up on debt, right? For most companies. And even if it is a debt-free company, equity also has a cost. So if you had to use free cash flow to value a company, the best method would be to compare the cost of capital, weighted average cost of capital, to the free cash flow margin, and see if there is what we call as an economic profit. So cost of capital is, let's say, 8%. Free cash flow margin is 12%. So there is an economic margin of about 4% there, right? That shows you that this stock is has a very strong balance sheet, and it's kind of, I can say, when you then look at basically the price factors, and then say, okay, fine, for somebody that is generating an economic profit of, let's say, 4%, 7%, whatever, is the price multiple justified, right? With that sort of an analogy, then you can use free cash flow as a sort of valuation metric itself, right? But given all that, you don't really need to go into a lot of complex mechanism. Buffett uses this very, very easily because passive investors do us a lot of favor, right? Because most of the money is going into overvalued stocks. They're not going to look at the undervalued stock universe itself. You can apply a certain threshold and use this as a margin of safety, and then pretty much invest on that basis, right? About 40% of the market is driven by passive investors, index-based investing. And then there is another 30 to 35% of the market that goes in block trades. These block trades are essentially institution to institution, right? So as an example, let's say, you've got Fidelity and you've got Vanguard, right? So Vanguard is, let's say, offloading 100,000 shares, or maybe let's say 1 million shares of Tesla, and then basically Fidelity is buying that. So that sort of block trade is about 30 to 35% of the overall market in a year. And then if you actually look at it, that volume is not even seen in your volume chart at all, because those trades don't happen during the market open period. It happens late at night or whatever, and it basically happens institution to institution. So between, let's say, that 40% of market that is driven by passive investors and another 30 to 35% of the market that is driven by block trades, you've got majority of the money kind of tracking towards overvalued stocks that are mega caps or large caps. And then you have essentially, let's say about 25% of the market that is actually driven by alpha generation, right? That is where the value lies. Only a simple analysis, just like we said, using Gemini, you can go in and basically do this sort of a spreadsheet and then look at it. So as an example, within the S&P 500, you can easily find around 400 stocks that are fairly valued, right? So how many stocks are on the S&P 500? It's actually 503 stocks. Though it's called S&P 500, it's actually 503 stocks. And the Magnificent Seven, which is the 7 tech stocks, etc., that takes about 35% of the S&P 500 weightage. So if you kind of remove that, 65% of the S&P 500 weightage is kind of distributed across 496 stocks, right? Because the whole index is 503 stocks. So 65% of the index is distributed across 493 stocks. A vast majority of them are getting less than 1% allocation of capital, right? And then if you just sort your spreadsheet by the valuations, so you're doing price divided by average EPS over 5 years. So if you just did that, and if you basically sort your spreadsheet by that, let's say you kind of apply a threshold of maybe 20 or 25 times of earnings, right? You just apply that threshold. I'm pretty sure you'll find 350, 400 stocks in there that are fairly valued. And you can pick from those 400, 500. These are index stocks. They're not going away that easily. It's not going to be, one of those, let's say, pink sheet kind of company that basically trades, once a year or something like that. There is enough liquidity in the market, etc. So just by applying that, you've got a fair number of stocks to play with, right? So this is exactly what Warren Buffett and many value investors do, because they know that by driving a vast majority of the market towards passive investing into market cap weighted index funds, you've got a whole variety of stocks to play with, right? And if you kind of know how to pick the right stocks, then it's not very difficult to kind of generate pretty much a good investment return. Now, one of the things that we do is at Helix, we're using a 8-factor model.
Sorry.
Yes, Manish.
So that last bit, you run the 5-year price to earnings, and from there you can basically see when you run that, what exactly are you looking for? Is it like the percentage is higher, lower? How does it work? Sorry, I'm not.
Okay. Here is how this works, Manish. Right now you've got a list of stocks.
Yeah.
In the S&P 500 or FTSE, whichever index that you're taking, you take that. The next column over there is going to be basically the weightage in the index, right? And then the third column you're going to ask Gemini to create is price divided by average earnings over 5 years.
Okay.
Okay. Once you get that, export this into Google Sheets.
Okay.
Okay. So on Google Sheets, column A is the stock name, column B is the weightage in the index, and column C is the price price earnings ratio for that particular stock.
Yeah.
Right. Now go and sort column C by let's say what do you call that? Basically the ascending order, right?
Okay.
So you have the smallest to the largest, right? And then what you also do is you also set a filter to, let's say, 25. Okay. So if you filter out all the stocks that are above 25, right? So you've got a list of stocks which are fairly valued on the index. They have sufficient liquidity, and basically you can pick any of those stocks from there.
Okay. Okay.
Right. That's one I can say very, very simple method. Right. And and if you basically look at the index weightage of these stocks, which are fairly valued, you will find that vast majority of them are below 1% weightage on the index. Right. So a lot of money is not going to chase them for the foreseeable future. So because a lot of money is not going to chase them for the foreseeable future, you have an infinite means of alpha generation. Why is that? That is where this slide comes in. Stock returns are inversely proportional to the valuations, right? So Pharma French, basically researchers who created factor models, first of all, and you also have Carhart, another researcher who also worked on. He basically kind of took Pharma French. Pharma French is basically two researchers essentially, right? Pharma and French, right? So what Carhart did was to take Pharma French's factor model research, and then Carhart went on to do further research on that, right? So among the various factors that drive stock returns, two factors that distinctively stand out. One is size and the other one is valuation. Right? So the smaller the company, basically the larger the returns that this particular company is able to generate because it grows much faster. The valuations, again, the most undervalued companies are the ones that perform significantly better than the overvalued ones. This is irrespective of whether the market is having a bull run or a bear market, right? So that is the reason why I said at the start of this session, so far, all that you learned was understanding and kind of correlating various factors, etc. Now is when you're going to predict, right? And one excellent prediction mechanism is the valuation itself, right? In the history of the stock market, undervalued stocks perform significantly better than the overvalued ones. Entire history of the stock market, right? And for all practical means, we are basically helped by the passive investors because they are working completely against the history of the stock market by allocating more and more money into overvalued stocks that are mega caps. Right? So as long as passive investors continue to drive their money there, and we have them locked within tax wrapper structures, now, we don't need to actually do a lot of work in actually generating returns because this particular spreadsheet itself will pretty easily find out, okay, I can pick 5 of those and I can just allocate, let's say, 10,000 pounds each and jot down the next 5 years my difference in returns from the market will be significantly better, right? And how does that work? Our backtest 2015 to 2025, it tells us that the difference in returns just by doing this spreadsheet mechanism, nothing great. This simple spreadsheet mechanism, nothing great. In Indian market, you're expecting about 20 to 30% above market returns, right? In the European market, 11 to 18% above market returns. UK, 8 to 20%. US, 12 to 15%. Right? What did we do? We just worked a little bit of intelligence into how a vast majority of money flows happens using the passive investing mechanism, block trades, etc. Vast majority of the money is going to go into this one. I'm going to basically pick the undervalued ones because that is where stock returns are actually generated. I take that, I allocate fundamentally sound ones, right? I'm not going to go and invest money in a company that is going to go bankrupt tomorrow, right? So I take the fundamentally sound ones, kind of filter out all the crappy ones. Then I've got a list of maybe, let's say, 400 stocks on the S&P 500, right? If I allocated any money to any of these stocks, I will be about 12 to 15% above the S&P 500. Simple, right? That's what the research by Pharma French and Carhart kind of tells us, and our own backtest also kind of gives us pretty much the same sort of input. So our backtest kind of, I can say, validated the use of these factors and the fact that valuations are kind of basically stock returns are inversely proportional to valuations. Right. Since about 2015, we have a new noise in the market. It's not signal, it's noise.
Sorry,
Yeah.
Just one question. Okay, I know you talked about the S&P 500, okay, right? But obviously there's lots more stocks out there. Okay?
Yes.
Would you justify using this same principle on stocks which are not in the 500?
Yes, you can use, see if you can use any index. And the reason why I advise you to look at index stocks is there is some ETF that is running on that particular index, and you are going to have liquidity on that particular index stock.
Oh, I see. Okay. Because you've got a passive fund which is buying into that index.
They are piling money into that index any which way.
So how do you find out if a stock is an index stock?
TradingView. Basically, if you go and look at it, right, on your stock screener, you can select stocks that are on S&P 500, NASDAQ, etc., and then it will basically give you that list.
Oh, okay, so you wouldn't do the FTSE, you wouldn't do all of the stock, you wouldn't do the FTSE overall, but you would only do the FTSE 100, for instance, right? Because the FTSE 100 is an index.
Yeah, FTSE 100 is quite popular among the passive investing crowd.
So you go with an index. So there are lots of indexes. Not all indexes are the same, and not all of them will attract the same volume of passive investment. So if you choose the right index, you might have an ETF for tech stocks, okay?
Yeah. And multiple ETFs.
Yeah. Multiple
funds on that particular index.
On that particular index. Okay.
Yeah.
All right. Okay, I understand.
So choose that index. Ask Gemini to give you the constituents. Find the weightage in the index and also the valuation, and then there you go. You can go and pick maybe among the FTSE 100. You might be able to pick, let's say, 50 stocks.
Right. Okay.
Right. Simple. Essentially. Right. Yes, Tanaka, you had a question.
Yeah, just a question. So when we look at that price to average earnings over 5 years, is the lower the PE, the more almost margin of safety or more return that we're likely to get? That type of thing.
Absolutely. Absolutely.
Thank you.
The lower that multiple, right? Basically, research tells us that in the history of the stock market, stock returns are inversely proportional to the valuation, right? So if you have stocks that are overvalued, obviously their returns are going to be lesser than the undervalued stocks. Simple. Right? Now going into ESG, and the reason why we are basically looking at it is since about 2015, a number of listed stocks started seeing what they call as an ESG rating, right? Funny thing is, the ESG rating mechanism is not very dissimilar to maybe a credit rating, but then the credit rating is based on hard fundamentals, while the ESG rating is based on narratives, right? So the company could say, I will do this by 2050, nothing done today, and then the rating goes up, right? And as a result, what happens is, you might sit here and say, no, I don't believe in the ESG story. I'm not a green investor. I don't like green stuff, etc. Whether you like it or not, just by the fact that the company has a ESG rating, the stock price is having a premium of anywhere between 5 to 23% in comparison to its peers. Now, if you want to check this, what you have to do is you'll have to ask. You can go into Google Gemini, run a deep research, ask it to identify a stock and peers, right? So among the peers, you wanted to identify at least one peer that is not ESG rated, right? And then you wanted to create a table which kind of tells you basically the name of the stock, the ESG rating, and the price to earnings ratio, earnings over average earnings over 5 years, right? So you get that. If you just compare it to the peers, you will find that shockingly, the non-ESG rated company, it might have a excellent balance sheet, fantastic business, great competitive moat, but is rated at least about 5% lower. Basically, the valuations are about 5% lower than the ESG rated ones. So the difference in some sectors, basically the difference can be up to about 23% in the ratings. So how do you find this difference? All that you have to do is basically tabulate the basically the P by E numbers, and then calculate what is the percentage difference between them. And then you will find that basically the ESG rated ones have a premium valuation of about anywhere between 5 to 23%, depending on whichever sector you are actually looking at. So for me, I know that, okay, ESG, yeah, it's got to be there in the market. And I am a believer in basically the green transition. But as far as I can see, a number of companies are greenwashing their way. So my point is, am I paying Ritz-Carlton prices to eat a Subway sandwich, right? Is it justified? How do we figure that out, right? We're going to talk through some of the mechanisms that many of these companies use, right? It's called the smoke and mirrors test, right? So number one, mechanism that a number of companies like Microsoft, Meta, HSBC, TCS, Infosys, I can probably list a number of companies using offsets, right? Carbon offsets. So if you ask Gemini to go and find this, right? It will go and find out if the company is using offsets. So they are not doing any real work. So what they're doing is they're just paying some money to somebody and then saying offset my carbon, etc. That does not mean any change in the business model at all. So, but by doing that, what will happen is that ESG rating will go up and automatically their valuation is higher, right? So as a comparison, a peer that is non-ESG rated might have a valuation of, let's say, 10 times of earnings. This company will have 25 times of earnings. So that sort of a difference is there just by using offsets. And how much money are they paying for that? Not a lot, just a rating and offsets, that's it, period. So you can discount those premiums completely. So so when you kind of find that, and then you find one of the peers, they're not doing this, this one is basically doing it, you write down, basically discount all of the premium. Essentially, if the premium is like 15 times of earnings, discount all of the premium, it's only going to be 10x of earnings. That's it, right? The second method, a lot of companies do. Amazon is an expert at doing this, using some minor victory, right? Minor green victory somewhere to claim a premium, right? So one small thing like, we switched one of our warehouses to have solar panels. So we are not buying fossil fuel based electricity for this one. We put solar panels on top of one warehouse. So it's basically a happy meal from McDonald's, not even a healthy Subway sandwich. Definitely not worth the Ritz-Carlton price, right? So that is called as a hidden trade-off. A lot of companies do this. I gave you an example of Amazon, lots of them, right? The third thing that happens is, you know what, Manish, Nessa, Tanaka, you guys want my product, so I have to keep producing this, right? This is like, basically the, chip shop that you go to, what they've done is they've taken the frozen, chips and dunked it straight into hot oil. So the end product, if you basically look at it, you'll have a crisp exterior, but then when you bite into it, it's actually cold potato inside, right? That sort of a narrative is something that oil companies do a lot. Chevron, ExxonMobil, Shell, BP, etc. Shell is famous for basically selling offsets 5 years early, right? So what they did was they did a carbon capture project somewhere in the US, and they sold the offsets to basically to clients for 5 years before actual delivery, right? And the way this is basically being sold is that I have to keep producing this because you guys are asking for more and more petrol, more and more diesel. You guys are buying diesel cars, and that is the reason why I have to keep producing this, right? You see that that's basically another example of this. So another example is, we call it as the Jevons paradox, right? So how many of us have gone into maybe some hotel that we are staying, and then the as part of our room booking, it says free breakfast buffet, right? You go there, you load up. Your normal breakfast is probably going to be 2 pieces of toast, and at a maximum you're going to have maybe a cup of coffee. But then when you go there, what you do is you probably have maybe a bowl of fruits, and then some cereal, and then get some toast. There is beans. There is let's say some hot dogs, etc. You basically load up, right? This is the exact same thing that happens a lot in the market. right? Example is NVIDIA. Many companies say because the efficiency went up, more and more customers are buying more and more of my product. So that ESG rating is not at all justified because they are selling more and more, and actually as the revenue increases, their emissions increases. As the revenue increases, they are squeezing more out of their employees. As the revenue increases, basically they're doing more harm to everything around them, right? NVIDIA is a great example of that. We'll see in the next few sessions, we'll talk about the triangular conflict. So in that one, we will talk more about this particular thing called as the Jevons paradox. And then we also have companies that have a business model conflict. We will cover more of this when we talk about the triangular conflict. But then a great example of this is Airbnb. Their business model exists to chase renters out of the market and to kind of gentrify your area. But then they have the best ESG rating. Their ESG score is top notch, right? So if you basically look at the premium that Airbnb kind of has because of that ESG rating, 20%. The valuation is 20% higher because of an unjustified ESG rating. If you just peel that ESG rating off, the valuation drops massively. That's the reality for these sort of companies. There are lots of examples of number 5. And then you also have a number of companies that have enforcement actions, lawsuits, fines, penalties, right? If you just go, basically a great example that I keep giving is, frequently if you walk down any of the high streets, you will find maybe a cafe that has been shut down by the council for hygiene standards being violated, or they didn't have the right licenses to employ people, or maybe they found cockroaches in the kitchen for whatever reason. Those sort of companies, you have a vast majority of them having fantastic ESG scores, right? So is the scoring mechanism considering this? The scoring agency like MSCI, if you contact them, they will tell you, yeah, this enforcement action came in 5 minutes after we issued the report, right? So next year when we do an audit on this company, this will be taken into account, and the rating will be automatically adjusted by that. But during that 1 year period, a number of ESG funds have piled their money into this particular stock, right? But can you peel it back? Yes, you can peel it back, and basically, you can use Gemini Deep Research in order to peel back all of these. I'll give you the exact prompts to use as well in the next few slides. Yeah. So this is basically one of those prompts that you will use. So this is the valuation filter, right? So what you'll do is to execute this onto the Gemini Deep Research. You'll receive a copy of this PDF. It'll be on your WAP screen, so you can go and look at that. So with this, you can go and see for your target company. Let's say you're looking at Tesla. So you'll say, while performing the eco-efficiency analysis for Tesla, specifically audit them for these 4 smoke and mirrors categories: offsets, hidden trade-offs, product volume conflict, Jevons paradox, etc. Provide evidence from their latest sustainability report or third-party investigative journalism, right? So you can ask Gemini to do a deep research on this, give you this input, take this. Now what you will do is you will then go and upload the deep research report that which you get. You'll go and upload this onto NotebookLM. Okay. On Notebook LM, what you also do is this presentation, when you receive the link to WAP, you can go and download the presentation. You can go and add this presentation also into Notebook LM. Now you can ask Notebook LM to define the Ritz-Carlton versus Subway sandwich kind of an analogy in the context of stock premiums for the stock that you are evaluating. So let's say you're evaluating Tesla, you'll put in Tesla, and then in comparison to its peers, you already identified a set of peers, isn't it? In our first session, we did peers, etc. So you'll put in those peers. And then you will ask Notebook LM to summarize the four smoke and mirrors failure points. Right? And then you'll also tell Notebook LM, because you want it to become the brain, essentially. I will need you to apply these specific filters later in the analysis. Meaning, as you go and do this for other stocks, this kind of filter is something that Notebook LM will need to apply for you. So that way, what you did was take this, load it in, ask Notebook LM to kind of do this in terms of stock premiums. And you will see, okay, there's a 5% premium there. There's a 10% premium there. There's maybe a 20% premium over there, right? You'll be shocked at how much of a premium many of these companies have as an unjustified premium itself. Then what we'll do is we will do the third step, which will be again on Notebook LM, right? You want it to kind of reconcile its brain, right? So all the work that it has done so far, you want it to kind of reconcile the brain. Now reconcile the stock's current valuation with the Helix valuation integrity framework, right? Now, first of all, look at the regional benchmark, right? The countries, basically the company's primary market. If it's US, then what is the benchmark? What is the historical return differential for undervalued stocks in that particular region, right? And then do a premium check, ESG rated stocks. So we already ran the premium check in our previous prompt. So we can take that. So we are telling Notebook LM, ESG rated stocks often see a 5 to 23% price increase based on our findings. Is the target company justifying a premium, or is there a Subway sandwich, right? So you're going to get that. And then number 3, if you found any of the smoke and mirrors, should we discount all the premium, or should we give basically an adjusted valuation, right? So when do we discount all of the premium? When any of those smoke and mirrors are existing, right? If none of those smoke and mirrors are existing, the ESG rating still holds good, right? So maybe it's not a Ritz-Carlton experience. Maybe it might be, let's say, DoubleTree. So how many of you have stayed at DoubleTree? You have? Okay. So what's the one distinct thing that DoubleTree does, which you won't see anywhere else?
I'm not sure. I can't. It doesn't. I don't remember.
Okay. Did you get freshly baked cookies when you checked in?
Maybe. I can't. I don't remember. But okay. Is that what they do?
Yeah, DoubleTree is known to do that, right? The other thing is also that you can get more and more of those cookies at any time you want.
Oh, okay.
Okay. The experience is fantastic. Great rooms, fantastic ambience, nice restaurants over there. If you booked basically with basically the breakfast buffet, there's a fantastic spread in the breakfast, and the breakfast is available from about 6 in the morning. So if you have an early morning flight to catch or whatever, you're checking out, have your breakfast. They will actually tell you, in comparison to all the other hotel chains and whatever. If you stayed at a DoubleTree and you're checking out at maybe 7 o'clock in the morning, you're checking out, you go in, and then they will tell you, sir, do you still have some time for breakfast? You can try a fantastic spread, and if you want to carry some of the stuff in a small paper bag, you're free to do so, right? That experience means that a lot of people, once they get hooked onto DoubleTree, what they will do is, if they are traveling to another city, they will choose DoubleTree again, right? So it might come actually at a premium. So you might end up paying, let's say, 20 pounds more, or maybe 50 pounds more per night. But you will say, okay, as soon as I got in, I had like this, instead of that stupid welcome drink that many of these places have, right, which is kind of sore on my throat, I've got a warm cookie that I can take to my room. I can enjoy at whatever time. I can get more of those cookies. And then the people there are telling me, okay, even if I'm checking out right now, I can still have my breakfast or whatever. It feels like home. It feels a little bit like maybe you went to your parents' place, and then basically mom says, don't go, on a sort of empty stomach, maybe carry something on your way, or maybe just it's that sort of a feeling, right? So you might still want to pay a certain part of the premium, but if that premium is justified, right? This is exactly what we are asking Notebook-LM to do with this particular prompt. So you're going to receive all of this in the PDF, so you can go back and basically check these. So what we would want you to do is to go and test these for your watch list of stocks, right? And then report it back on the WhatsApp group for comparison and to have a great discussion. Doable? Tanaka, Nisarg, Manish?
Yeah, that's doable.
Yeah. Report it back on the WhatsApp group. Let's have a great discussion there. So, recap of today's session. First of all, earnings are an opinion, right? It's not reality. Though the financial media, a lot of analysts, a lot of fund managers, everybody is going to drive you towards earnings. It's basically a matter of opinion. Secondly, just by observing how passive investor flows are going through, we can identify a number of undervalued stocks. We can apply a margin of safety, and we can pretty much invest in a vast majority of the market. Many companies manipulate their numbers, even the most trusted names. Give me any trusted name, and I can tell you in the last 5 years whether they've manipulated their earnings. There's a very good chance, right? We all have a lot of trust on the banks in the UK. I can tell you vast majority of the banks have inflated their sales numbers over the last 5 years, last 10 years, easily. ESG adds a premium, whether you like it or not. The question to ask is whether that premium is justified or not, right? So what we will do as a homework is basically to sort of peel back on the narratives and get the true valuation, because valuation is an excellent mechanism to predict going forward, right? So things to report back to the WhatsApp group. So previous sessions, we did understanding beta. How did it change your perspective on the stocks that you invested in? Choosing benchmarks, your findings, choosing peers, the NVIDIA rule, the TCS rule, etc. How did you choose the right peers? Revenue to cash flow, and basically the contrast to sort of earnings. Debt, is that essential for this business, for the stock that you are investing in, or is it a burden? What did you find out, basically, right? And then competitive advantage, what are your findings for the stocks that you analyze so far? macro environment and cycles. Great question right now is because there is a ceasefire in that Iran-US conflict. Are we back to normal? Are we back to normal? Is everything hunky-dory today? Does that change your investment perspective? Right? Again, some work to do there, understanding where we are on the macro cycles, what is happening, etc. Right? And then today's session, how you peel back the narrative on valuations and how you found basically the right kind of valuation for the stocks that you're looking at, right? So I would want you to go back and basically do your own assessment, and then look, looking forward to next session. So in our next session in 2 weeks' time, we will look at the impact of KPIs and forward look. Where do you get that? Mostly we get it in earnings calls. And every listed company is running earnings conference calls. Why do we need to listen to the earnings conference calls? Or maybe read the transcript of the call later on? And how can we measure and monitor the momentum? Because momentum is one of the factors that can help you predict stock returns, right? In comparison to beta, which is kind of the narrative, which is basically the sort of correlation to the market. Now we are looking at valuation, we're looking at momentum. Again, these are mechanisms for you to predict what is going to come up, right? And how can you use the earnings call as a mechanism to kind of predict future price movement, right? Is this company somebody that kind of under promises and over delivers? Are they somebody that will walk the talk, or are they just like Elon Musk, just a piece of shit, basically fluffing their way through the market? And because of the fact that there is so much of money loading up on passive investing funds, he is just freeloading essentially, right? So is that what is happening with the company that you're looking at, or is there a real value that you are kind of finding out? So that's what we're going to figure out in our next session in 2 weeks' time. Okay, any questions for now?
No. I need to go back, and I think it's session 3. I think I need to redo that one actually because I was away.
Okay.
But,
Yeah.
3 or 4, I think. But yeah, I'll have to go back.
So I just had a question. So in terms of valuations, with everything that we discussed today, is there a place where, and maybe it's if you like later in one of the sessions, where we determine a price target, like in terms of this is a fair price to pay for this share, and everything below I'm coming in, when it gets to this point, maybe I'm selling, or that kind of thing?
Yeah. That is the margin of safety, Tanaka. You kind of nailed it really well, right? Now, when we said, take this spreadsheet of the index stocks and, order it by, the price to earnings ratio. And then we said, let's go and set maybe a threshold. That's the margin of safety. So you could set a threshold of maybe 20 times of earnings or 25 times of earnings, whatever is that number that is right. I generally say between 15 to 25, you are very safe, right? If the valuation exceeds about 25 times of earnings, again, what I'm looking at is basically price divided by earnings over 5 years, average earnings over 5 years, not the instantaneous trailing 12-month sort of nonsense or forward look EPS sort of nonsense that you see. Don't use that at all. So if you're looking at that, then anywhere between 15 to 25 is a fairly valued stock, right? So you can kind of apply those thresholds, and if you kind of order the table apply those threshold, filter it by don't take anything below 15, don't take anything above 25, just give me the list between 15 and 25. That list is pretty much investable. Those stocks are fairly valued, essentially.
Okay.
Yeah. Any other questions?
And then I suppose the stuff that we were just talking about, the ESG, you could use that to actually look into the fairly valued and strip out the ones where
strip out the premiums. Exactly.
Is contributing heavily in the premium when it's not justified because of the smoke.
It's not justified. You basically discount it, compare it to the peers and discount it. So you might have got, let's say, for a particular stock, you might have got, let's say, 24, 25, maybe 24 times of earnings. But then when you ran this ESG check on Notebook LM, it says that the premium is about 5 times of earnings, and it's not justified. Now what you do is 24 minus 5. The actual valuation should be 19.
Yeah.
So what is the price when it is 19? That is the price at which you should enter.
Okay.
Right? That does the job pretty much for a vast majority. And again, why are we looking at index stocks? That's because a vast majority of the money is circulating based on passive investing. And these stocks, whether they are 1% of the index or 0.5% of the index, it is still going to see those liquidity flows, right? So you're not going to be stuck in a situation where the stock is not trading, I can't sell out, or the spread is too high. Just because of the fact that they are on the index, the spread is going to be reasonable, and it is going to have consistent investment flows coming in every single day. Right?
Yeah.
So Nisarg, any questions? Been very silent today. Nisarg is on mute. Okay. If there are no questions, then we'll close the session. I'll upload the recording, and you'll see all the prompts and all that in there. So I think you can go ahead and.
Hello, sorry, have I unmuted? I was trying hard.
Yeah. I can hear you
I'm
now.
sorry. No, it is brilliant because in the bank that I work, there is so much of ESG faff that goes around. ESG industry employs at least 20,000 people in London. Lot of faff. It's complete.
Yes.
It's actually anti-emerging economy. Like, I can pick any Indian institute and say, you did exploitation of people, so ESG rating will be going low. And actually, exploitation could be higher in Leicester here, right?
Yes.
Now,
exactly.
there's a lot of literature on this. There's a lot of confrontation between emerging and submerging economies like UK. I'm being sarcastic here. But I like this, Soumi. I never thought that as an investor, this can be stripped off, because we have been programmed to think that ESG is part of life. And again, when you work in the industry, it is like, this is mandatory and all this. I'm with HSBC right now, the group CEO, and we have Danny Alexander, the politician in the ESG space.
Yes.
But I really like the dimension you gave. I never thought in this way. So this is very good.
Fantastic. Thank you.
Yes.
Great then. If there are no questions, then let's close the session, and I'll upload the recordings for you guys. Yeah.
Thanks.
Thank you.
Okay. Right. Thank you.
Cheers. Bye.